What's up, guys? So this video is going to be about how you can actually make money in the stock market. So we talked a little bit about what is a company, a PE ratio, like how to simply evaluate it. We talked about how to build a position, and we also talked about, the time value of money, right? So, there's a few ways you can make money. One is obviously you buy and you sell, right? Buy low, sell high, right? The second option is you hold long term and they just give you dividends, right? Third way is there's share buybacks, right? So the actual company you invested in, they raise money or they use some of the money they made to buy back the public shares, therefore increasing your shares values. And obviously number four is you hold and the business itself grows and it does great. So those are really the key ways. And then obviously number five is there's probably like a takeover, which kind of goes back to just someone buys you out, in a sense, right? Now, each one of these factors, they have a very interesting, perspective between them. And I'll give you some examples to help you better understand, like, what you might want to be doing. Because, like when you get into something in business, they call it like an exit strategy, right, in your business plan. So how are you going to get out? How is everyone going to get their money back or whatever, right? Same kind of difference for stocks. See, I would buy and hold, forever if it's a really great company, something like a Berkshire Hathaway or like a Coca-Cola, but there's a lot of short-term plays to be made out there. You might not want to hold that company for decades and decades. You might just want to, get rid of it and whatever. So reverse back. So if you buy a stock for $1, you sell it for $2. Hey, great. You made like 100%, right? The difference here is if you sell it, you have to pay capital gains. So what capital gains is any gain on capital that you originally invested, right? So anything above that dollar that you put in, if you cash that out, you got to pay tax on that. Now, if it's less than 12 months, then you got to pay a higher, it's 30% plus. If it's longer than 12 months, if it's more than a year, if you hold it for more than a year, then it's long-term capital gains and it's 20%. So, that's one way. That's one disadvantage of just buying and selling. But hey, if you're paying taxes for something, that means you actually made a lot of money. So, you're fine. Now, the second way is obviously dividends. Now, this is kind of like, they call it double taxation in a way. Let's see what you guys think or how you view it. I don't know. I'm in between where it's, I'm all about paying, your fair share of the pie, but at the same time, that's why I like real estate, because it has a little bit more safe havens, right? So the reason why it's called double taxation is, well, you're a corporation, right? Let's take Facebook, Amazon, anything, right? You're a single corporation. You paid like 20% in taxes, right? Or 21 right now. I can't remember the exact number. But anyways, a corporation pays its taxes, right? And then, it says, okay, boom, we have this many profits left over, this many X number of dollars. Now, the corporation can make you money in different ways. And when you're looking at a stock, when you look at it where it says yield or it says dividend yield, a lot of people like that. They like getting money every 3 months. But that's necessarily doesn't mean it's the best thing for you. It's not compounding your money the best. Some people are like, screw that, give me my money. I'll figure out what I want to do with it. You know what I mean? If I bought this company for $100 and it's giving me, $5 a year, give me that $5. I'll go buy something else, whatever. But here's the problem is the corporation makes the money and then they say, okay, we paid their taxes. Okay, we have this many dollars left over. What do we do with this money? They could say, okay, we'll give 10 or 20 or 30, whatever, how many of a percent back to our shareholders in a form of a dividend, right? So that's one way. You could be a dividend investor and just say, screw it. But here's the problem. You own that company. You've already paid 20% because theoretically, when you own a stock, you own that company, right? So you already paid 20% plus sometimes maybe depending on what it was, taxes for that. Then it comes down to you and you collect it as a dividend. But that goes on as income on your taxes. So you got to pay your personal taxes on that, right? So that's why it's double taxation. So that's why a lot of people don't really like the dividends once you start getting up. It's all about the different levels of investing, right? So maybe if you're a little bit older and you saved $1 million or whatever, and you go into like an AT&T stock and they're willing to give you 50 grand a year. And you know what? Right now, the way you budgeted your life plus your little savings you have and houses paid or whatever, that's perfect. People like us, that doesn't make sense. We're young, we're trying to compound and grow, right? So these are things to think about when you're thinking about stock investing. And if you're thinking long-term, then this is something you really want to think about. If you're thinking short-term, who cares? You're looking at the fundamentals, news, whatever you're trying to trade, right? So we went over that you could obviously buy and sell, and dividends, and the downfall of dividends, and the benefit of dividends. You get a steady income every 3 months, right? But the taxation, remember, capital gains still applies to those dividends, or those, you know what I mean? The corporation pays taxes, you pay taxes, and, you know, if you go over a certain threshold, it wouldn't be capital gains, it would just be income, sorry. But, so that's that. So what else can a corporation do? Well, another corporation, take like Berkshire Hathaway, for example. We're all familiar with Warren Buffett. That's his company. It's a conglomerate in a sense. So they own like See's Candy. They own BNSF Railroad. They own a bunch of small, like they own DQ. You know, they own a bunch of small businesses. So their business philosophy was, well, we're going to try to make the most money for you as a shareholder, but we're not going to, you know, give you back a form of a dividend. Your value will come when you sell the stock to somebody else, and it's just going to keep growing. And remember, this stock started off at $10,000, you know, way back in the day, and it's trading at over $250,000 today. So if you would have bought one share, I mean, just think about that. Think about the growth that it's had. And they have a B-class share that, you know, people like me and you could buy for like $185 or close to like below 200 right now. So what they do is they take money, they hold money, and they say, you know, we're not going to give you the dividend. And they don't really hugely do share buybacks. We'll get into share buybacks. But what I was trying to get at this point is this company, Berkshire Hathaway in particular, they put the capital to work by buying more businesses or reinvesting in the company, right? They might open up new DQ stores. Or they might, you know, for Geico, because they own Geico, they might say, you know, we're going to, you know, double down on new insurance policies, you know. So that's another way, because then by doing that, and when more money starts coming in, the value of that stock would start going up, right? So, and the other form is buybacks. So, and this goes into the whole crazy credit cycle thing that's going on right now, and people, myself included, believe that, you know, you have these zombie corporations, and basically they just borrowed money to buy back their share, to make their shares go up, when reality is their share's not really worth that much. It's just there's a less of a share, but that doesn't mean that necessarily that is the value of your company now. Getting a little bit out of hand here, but basically, you know, let's say me and you bought a company or started a company together, and hey, we made it big, we IPO'd, and, you know, everyone got a, you know, a piece of our shares. We're traded on, you know, whatever market, you know, Dow Jones, S&P, whatever. And, you know, basically now we made our first $1 million, and we're like, man, what are we going to do? Well, we're like, well, we don't want to expand into the business because we got what we can handle. There's no point in just sitting on the money, and we don't want to pay dividends because we know that it's going to double tax our stockholders. So you know what we'll do? We're just going to buy back the stock at the public market. So therefore, the stocks shrink and the price usually goes up. So these are the ways that you can make money being an investor in stocks. And obviously, if someone comes and acquires you, you could obviously do that. And obviously, if business just starts booming, right? If you were like 3M and you started selling all kinds of masks because of this pandemic that wasn't expected, you just made a crazy amount of money, then it's going to push the stock up, obviously. So just to recap everything, because a lot of people might not know these details about the taxation and all that, I'm going to try to break it down one more time quickly in layman's terms to just hopefully you take one thing from this video, right? So you can make money off of dividends, but dividends go into your personal tax, and that ends up costing you more because, you know, the corporation gets taxed, you get the dividend, and you get taxed again, right? So it's double taxation. Obviously, you could buy and sell, but then you have capital gains, which is short-term and long-term. Short-term is 12 months and under, and you get charged a higher rate. Long-term is 12 months and longer, and you only get charged, I believe, is 20%. Obviously, you can do share buybacks, or the company could just grow itself by making a better product or service and reinvesting. So anyways, I hope this video was helpful to you, and it gave you a better understanding of what it means to really own the stock and how you can profit from holding the stock rather than just buying and selling it. If you like this video, please share, guys. I hit my goal of 400. Thank you so much. I don't know, maybe 500 is next.